and I'm queuing up on my end. Does everybody see this? Debbie?
Ray, it looks like you're good to go to me.
I think it's important because the statistics don't, but the statistics people tend to ignore. And the problem is we all have good jobs. We're good at those jobs. So why would we ever go at any period of time without a paycheck? Here's the fact. An illness or an accident will keep 1 in 5 workers out of work for at least a year before the age of 65. And it's most likely going to be an illness, not some type of accident or some type of, the typical disability that you may think of. Illnesses account for 95% of disability. And I know, Jim, you have a story here that's related to this topic. I'd love to hear you share because I think it's such an impactful story, about how important, disability insurance is.
Sure, Ray. When I started in financial planning in 1980, I think it was in 82 or 83, I was fairly new at financial planning, and I got a new client, a young man in his mid-20s, and did a financial plan. And part of the financial plan suggested that that he needed disability insurance. And as Ray will talk about soon, and as those of you who have ever looked at it, disability insurance is not inexpensive. And so he didn't really want to buy it. And every time we met for an update or for anything else, I always brought it up. After about 1.5 years, he finally agreed to buy the insurance. So we bought the disability insurance, went through underwriting, got the policy issued. And about 2 or 3 years later, he contacted me, said he was disabled, and he needed to apply for his benefits. And he said he had a blood disease. Now, this was in the mid-'80s, and thinking back what we know now, and I'm pretty sure that the gentleman had AIDS, but I'm not even sure we had the term at that point. But anyway, he got sicker and sicker, and ultimately he passed away. But about 6 weeks before he passed away, he wrote me a letter and said, thank God I talked him into buying that disability insurance because it gave him the financial dignity to deal with his illness. Back to you, Ray.
It's a very powerful story, and that's why I wanted you to share it, Jim, and I certainly appreciate that. But what a lot of us probably aren't aware of is that everybody on this call already has an illness, or probably more accurately described as a syndrome, and it's the "it won't happen to me" syndrome. Disability happens to other people, not to us. But people's perceptions don't really fit the statistics. The average long-term disability claim is 31.2 months, as you can see there on your screen. 64% of wage earners believe that they have a 2% or less chance of becoming disabled for 3 months or more during their working career. It's just a huge percentage. And for somebody entering the workforce today, the actual odds are closer to 30%. And if we just take a look at these poll results here, out of everybody on this call, every single person on this call said that they were an above average driver except one person who said they were average. So if you take a look at what an average actually is, everybody can't be above average, okay? So if you take a cross-section of a group of people, that whole group of people cannot all be above average. And that's just to make a point that we all tend to think of ourselves as not being in a position of being able to have a disability when, in fact, the percentages just don't show that. So let's think about that. The retirees' challenges are really no less daunting. And this is a topic that I have some personal experience with. My 94-year-old great-grandmother, or grandmother, my 3-year-old daughter terms her great-grandma Malone, because she can't pronounce Malone yet, but she's been in a nursing home for over 4 years, and she's in excellent physical health, but she suffers from dementia. And thankfully, she had a long-term care policy purchased while she was working for the New York's Social Services Department. Now, I grew up in upstate New York where care is, while expensive, it's not anywhere near as high as in Northern California. So in addition to having a choice financially of where a loved one will spend time, her policy also offered a coordination of care benefit. Now, that's essentially somebody who works alongside of the family to walk you through the process, help you select an appropriate facility, assist in the billing and the reimbursement process. And for anybody who's gone through this, having to put a loved one into a facility is never an easy decision. And having the financial and organizational components removed from the equation, I know it certainly helped my family make the best decision possible. The average stay, if you do need long-term care, the average home or assisted stay is 4.5 years. The average nursing home stay is 3. But once you make it through the first year, the average jumps to 4 years. And that's essentially for people that go into they tend to pull the average down, people that go into a home for a short period of time before passing on. And if you happen to have Alzheimer's dementia, the average stay is 8+ years. So how do you really, when you look at these statistics, 70% of people over the age of 65 will need some type of long-term care in their lifetime. More than 40% will need nursing home care, and the average claimant is 78, but over 40% are of working age. What we're going to talk about really is how to protect yourself and your family from these pitfalls. Managing risk is an important facet of all areas of our finances, and I think these issues are really no different. In the insurance world, we talk about managing risk, and essentially there are 4 different ways that you can manage risk in your own personal financial life. Risk avoidance, reduction, retention, and transfer. Now, short of locking yourself into a closet for the rest of your life, avoidance really isn't much of an option. Reduction is one that I hope you practice, and it's certainly a popular option, and it's eating right and exercising, not using your hand glider as frequently as maybe you do, would all reduce the likelihood that a debilitating accident or disease will keep you out of work or needing care. Retention is what you're doing if you're not doing the other 3, okay? And just because you haven't made a choice yet to go out and look and see how you can get yourself covered for these types of severe catastrophic health events, you're retaining that risk personally. And you need to make sure that your balance sheet reflects that retained risk. Your personal balance sheet, that you're accruing assets to make sure that you can pay for a long-term disability or long-term care. And then if it happens to you, you're essentially on your own. The last option, and the one that we're going to focus on today, is the transfer of that risk. And this isn't always 100% transfer of risk. We may choose to do a combination of both retention and transfer. There's not always a need to over-insure yourself and insure yourself against every possibility. Realistically, we want to make sure we're covered for the catastrophic events, and at the same time make sure that our families are taken care of if we do end up in one of those situations. So I think maybe a combination of the 2 ends up being the best option overall. Let's start here with some solutions for if you're still working. There's really 2 different types of policies that we're going to look at. One is traditional disability insurance, and another one is a relatively new concept called critical illness insurance. These are available normally in 3 different places: through the workplace, through private insurance, or through, again, self-insuring, like we talked about before. I would encourage you to absolutely look at your workplace first. It's going to be the least expensive by far, for both of these types of policies. And frankly, you're probably going to be able to get more coverage than if you just went out on your own and started looking at private insurance. But not everybody has the luxury of having a workplace plan. So if you don't, you want to start considering looking at private insurance or self-insuring, or a combination of the 2. Let's start with disability. Essentially, disability insurance provides you with paycheck replacement. It's often a tax-free benefit. Its length is determined by plan design, but you can go up to age 70. Can allow for an ONOC version of disability, which I'm going to explain in 1 minute. And the premiums are typically based on age, health benefits, and occupation. Now, when I say it's often a tax-free benefit, typically whoever pays the premiums, if you pay the premium and you're paying it with after-tax dollars, you're mostly going to have a tax-free benefit. If your employer is paying the premium for you, your benefit is most likely taxable. Just to give you a concept there as how these benefits are received. The ONOC, if you will, which stands for own occupation version of disability, I think is very important. Let me give you an example. If essentially that says that if you are disabled, they're considering your disability, your lack of the ability to do your existing profession. So as an example, a surgeon damages their hands. They get nerve damage in their hands, so they can't perform surgery anymore. They would still get their disability coverage, even though they could become a medical director for an HMO, or they could do research, essentially go get another job, but still receive their disability payments. That's as opposed to an ENIAC version of disability, which essentially says if you could do any job, you're not going to qualify under that policy language. So you really want to be looking for an ONAC or a modified ONAC. I won't get into all the specifics, but that's a key term to look for in a disability policy.